Hello, everyone, and welcome to the WRA interview. My name is Sandal Sandmagam, and I'm the Portfolio Director for Europe for the World Refining Association. For those of you not familiar with our work, the WRA specializes in bringing the refining community together through conferences, board meetings, and now virtual conversations. We're involved in Latin America, the Middle East, Asia, and of course Europe. Now, COVID-19 has generated both social and economic uncertainty for us all. And given that many of our network is still in lockdown at home, we thought it would be good to provide you some industry insights. Today, I have with me Alan Gelder, who is VP Refining of Chemicals and Oil Market. Alan is responsible for formulating Wood Mackenzie's research outlook and integrated cross-sector perspectives on this global sector. He joined Wood Mackenzie's downstream consulting team in 2005. He transitioned into research upon his return from Houston in 2011 and has had various leadership and technical roles. Prior to joining Wood Mackenzie, Alan had 10 years of industry consulting after working for ExxonMobil in a variety of project planning and technical process design roles. So with that introduction, Alan, how are you doing? How is the lockdown environment treating you?
Sandal, I'm doing well, thank you. I don't think I've been in the same location for such a long time, for many, many years. So that has its challenges in terms of a routine, how to survive it.
What do you recommend?
The challenges of all the family being in the same place. One, make sure you've got very good Wi-Fi. Because I've got teenage kids. Some of them are, one of them's doing sort of remote schooling. The other, for my sanity, has been to instill a discipline of work. Trying to segregate work and home life. So there's one particular room I'm able to segregate. That's where I work. When I'm in there, I'm working, and when I'm not, I'm not. And actually, to a degree, reinstituted my commute where I used to walk across London to avoid the tube. Now I consciously have a walk to work and a walk from work to home, which is not just down the stairs, but actually go for 15-20 minutes around the neighbourhood just to get ready for work, and has some element of fitness. And I have been converting it into a little bit of a run every now and again, but it's not been quick. But yes, probably been better for me in the grand scheme of things.
That is actually something to take away. Thank you. Okay. Well, I suppose once we've discussed that, we can move on to now the more technical side and the area that a lot of people want to talk about, which is COVID-19. So how has COVID-19 actually affected you and your day-to-day with WoodMac?
Quite a lot. WoodMac does basically market analysis, asset valuations, so commercial insight into the energy value chain, and we've just seen a surge in demand for our views, our thoughts on things. COVID-19, the changes that have happened over the last couple of months have been quite dramatic. So we've seen a huge increase by our clients to understand what's going on, what it could mean for the market, what that could mean for them. And we've been living through some very uncertain and volatile times. So we've also had to get to grips with the technology to be able to host those correspondence communications with our clients. So the technical, we've not only is the challenge of getting the work done while working separately as a team, but also then taking our clients through what it means, what it might mean for them. So it's been interesting times.
And so I suppose you've been keeping a close eye on the refining sector during this period. So how has COVID-19 affected the European sector?
Oh, it's hit the European sector quite hard. So let me just show you some of the slides that we put together to show you the sort of latest view that we've got. I mean, what we're thinking, the outlook we've got is that European demand for refined products was at its weakest in April. It was down almost 5 million barrels a day on a year-on-year basis. We see a recovery underway now. The things that got hit the hardest were fuels for personal mobility. As I said, I live near Heathrow, and actually that's quite rare, a plane going off, actually. So the air is picking up a little bit. But in terms of the percentage drop in demand for jet fuel, it's been at the 80% levels. So a dramatic drop in jet fuel, similar or very large drop in the demand of gasoline, less so for diesel gas oil because we've seen the manufacturing still going and delivery of goods is still going to a lesser to some degree. So, but volumetrically, the fuel that's been hit the hardest has been gasoline, and the region that's been hit the hardest has been Northwest Europe. And that impact on demand has hit refinery throughputs. WoodMac's got the benefit of we acquired Genscape, so they do real-time monitoring of assets through their infrared cameras and storage facilities. And what they're seeing on the sites that they monitor is a significant drop in the utilization of FCCs. So chart on the left-hand side is showing the drop in the utilization on FCCs in Europe, and it's really quite dramatic. Right-hand side is hydrocrackers, less so, and that really fits with what we've seen in terms of product pricing, where in April, gasoline was incredibly weak at times. It was less valuable than crude. Distillate actually spiked up because of the cut in refinery runs, and so a lot of the impact on the refining system depends upon the location of where it is, the lockdown the country is experiencing, but also the configuration of the upgrading units that we've got. So quite dramatic changes depending upon those factors. So refineries cut runs to try and match the demand fall. They didn't necessarily cut hard enough. So what we're showing on this slide here is what's happened to inventories. And we've seen a significant build in product inventories in Europe. There are elements that are in floating storage for gas oil, distillates that have arrived into Europe, haven't been unloaded. And also there are significant volumes of gasoline that are in floating storage looking for recovery in what's happening in the US market. So biggest spike in inventory we've seen has been light ends and naphtha. This is something Genscape tracks for the ARA region. And what we're expecting is as demand recovers, as the lockdowns are eased, that actually those inventories start to work their way down. And so what that should mean is refining runs start to improve from April to May and continue to improve through June and July. But that improvement in refining runs follows the improvement in demand, just because those stocks need to be worked down. What happened early in May was actually European refiners saw demand increase or perceived demand increase and increased runs a little bit faster. So actually crack spreads had a period of weakness. We're now towards the end of May, they've recovered somewhat, but refining margins are weak, both in terms on a unit basis, but also utilization is down. And so refinery earnings for this year are going to be particularly difficult, which makes challenging times for the European refining sector.
Has there been a challenge to focus on the long term when survivability is the central issue, not just in oil, but across all industries?
Well, what we've seen is the questions that we're getting suggest that our clients and the industry has adapted quite quickly. So as we were going into February into March, the questions were really around survivability. How bad could this be? How deep could it be? There were lots of reports of global oil demand could be down 30 million barrels a day. There were some quite scary numbers, and survivability was really the key all through the value chain, not only for the refiners, but also catalyst suppliers, because if people aren't running FCCs, there's not the demand for FCC catalyst and all those sorts of things. So we saw a real focus on managing cost and operations to survive. Now, we believe we've gone through the bottom, and so we're recovering. Those questions are now changing to, okay, so what's the demand recovery profile like? What's happening to refining capacity additions? There was concerns about the medium-term refinery oversupply. Is that valid? Does that remain so? So the industry has switched quite quickly from we survived, yeah, okay, Phew, we survived. Okay, what's the world look like? How is it going to change? How has it changed from COVID? What could that mean? What could that mean for us?
And in the long run, do you think existing behavioural habits are going to be maintained, or is it going to be looking very different?
Oh, that's the killer question, of which, with hindsight, will prove wonderful. We've seen different behaviours in different places, actually. So, if we take China, for example, what we've seen is actually traffic patterns suggest that actually congestion in the major Chinese cities is more severe now than it was a year ago, as people have returned to work. And in returning to work, they've tried to adapt to personal safety, and so have actually travelling by car much more than by public transport. So we've seen in China an aversion to public transport. That creates potentially an issue in Europe, where returning to work without using public transport for the major cities is very difficult. So we may not expect European transport to rebound to the same degree. We need to see about lockdown behaviours, more working from home. The one that we think has got the biggest impact, that will last the longest, is jet fuel, just because of the bilateral relations and agreements that need to happen for people to move from one country to another. So it may well be that in-country travel will happen more quickly than travel between regions. What we're seeing, or as the economies recover, then mobility returns. The challenge we have is that we're thinking global economic growth for 2020 and 2021 will be weaker than what we had, and that will mean oil demand will be lower than what we previously thought, because of this economic weakness, because of this debt burden. So, but we're not expecting a complete transformation in the way the global population goes about the majority of its activities, because the technology for them to do that, the penetration is relatively small.
And when we move away from the data and the presentation, I just wanted to understand or hear your thoughts on the policy side. So do you think the Commission's Green Deal at the moment is going to hold up in light of COVID-19's impact on governmental budgets?
Again, a good question. I mean, what we're seeing is that the European Union is really challenged by how it deals with reinvigorating the economies and getting them returned to growth. There's been various proposals put in place. The French, German proposal for the Commission to provide loans, that sort of thing. So the feeling we have is that the financing associated with the Green Deal could be crowded out by what is happening to the re-establishment of economic growth across the region. It may well be, we think that will take precedent over what happens in the Green Deal. But when countries are reinvigorating their economies, lending to keep firms operational and functional, then that may have an impact akin to that Green Deal, because what was announced recently or proposed by Macron in France was a package to promote car buying in support of Renault, with an incentive to actually for the buyer to switch more to electric vehicles. So we need to see how these policies all come out. Green Deal might be threatened, but some of the individual policies the countries may have may well promote the decarbonisation of the sector, but then it gets quite specific around the industries that may well get supported by the various state initiatives. So difficult to say right now. We haven't, in our long-term outlooks, we haven't materially slowed down the rate of electric vehicle penetration. We've seen much lower buying or much lower purchases, but there's much lower purchases of us anyway. We still think the consumer will be rational, and we're expecting battery electric vehicle costs to come down. So we haven't really changed our view on that as yet.
And when we look at something that actually came up in the advisory board in March, we're looking at biofuels, and it was mentioned quite heavily about the EU's RED II. What are your thoughts on RED II? Is this affecting strategies for increasing biofuels production for refiners?
We think it is. I mean, if we look at the slide here, the key thing about the Renewables Energy Directive is it's incredibly complex. You know? So the requirement is that renewable fuels achieve a 14% minimum across each of the EU countries. There are various restrictions on various things. So there's a maximum limit on hydrogenated vegetable oil or FAME that come from rapeseed or palm oil through indirect land use change and all those sorts of things. There is support for biofuels from unconverted oil and waste fats. They get an incentive on an energy equivalence, a multiplier of 2. Advanced biofuels are heavily supported, which is biogas from forestry, biomass. They get support as well. But then the other one that comes in, so those first 3 you can argue are opportunities for the refining industry to use its facilities to process biofuels to get them into the fuel mix. But there is a challenge, which is the bottom one, which is around renewable electricity gets a very strong multiplier if it's used on either road or rail. And so this becomes a bit of a threat, we see. So what we're showing here is our outlook for the EU28 renewables in transport, and what we're showing various different categories. So we've got the advanced biodiesel share, which is in red, the typical biodiesel, which is yellow, ethanol green. The light blue is electricity in road transport, which is very small, and we've got electricity in rail transport, again, the dark blue. If we go from 2020 to 2030, we actually think that the Renewables Energy Directive, RED II, gets met slightly early, 2029, so not after 2030, but a key part of meeting that is that light blue element of the growing contribution of electricity in transport. And the key aspect of that is that multiplier of the factor of 4 to promote that electrification. So what that does mean, we believe, is actually the need for biofuels remains. It doesn't grow very much in terms of absolute volumes. It's something less than 100 kbd. What it is a requirement for is high quality biofuels, so advanced biofuels. Those are the things that the Renewables Energy Directive is promoting. Rather than biofuels en masse, larger volume, it's actually higher quality biofuels, so advanced biofuels. And that's where you then get into the EU legislation, but also the particular national regulations that define exactly what those things are. So we do see a growing need for biofuels. It's slightly undermined by electricity and transport, the fact of the way the regulations have been put in place. But the key thing is actually to have biofuels that can be double counted, so are advanced. So it's really a quality, not a quantity game.
And the next question I have is, which of the following do you see as having the potential to have the most significant effect on the future of the downstream industry? I know biofuels was something that was mentioned, but in the advisory board, we also had hydrogen, chemical recycling, and CCUS, which also works with hydrogen. But tell me, what do you feel is the biggest winner for the downstream industry?
Oh, that's a very difficult question. We don't see a silver bullet. I mean, if look at the slide here, what we're showing is the demand for mainland Europe by product is 1,000 tons a year by sector. So if you think simply of CCS, then what that could do is that could effectively capture the carbon associated with refinery fuel and loss, which is about 30 million tons a year. Yeah. So this element up here, this 4% mix. So but that's something the industry needs to do to manage its own emissions. The petrochemical recycling, if you look at the chart on the right-hand side, then there's this red area here that's showing the petrochemical feedstock demand within Europe. So that's a very big number, 78 million tonnes a year. It's about 11% of demand. So if refiners want to become part of the circular economy, then that's a key opportunity to go after, to chemically recycle, to reduce the need for virgin feedstocks. But for that to work, any emissions associated with that need to be dealt with. So again, CCS comes into this. The other thing is that we do modelling of all our refinery sites. We've got linear programs, we pull all the data together. And European refiners produce over 2 million tonnes a year of hydrogen already. Now, most of that is consumed internally for reducing the sulfur content and reducing other product or achieving other product quality requirements. But if you've got CCS associated with the refinery, then more of that hydrogen takes on a lower carbon charge or cost associated with its use. Now, 2 million tonnes of hydrogen could well replace 6 million tonnes of diesel. That's relatively small. So, but again, it's one of these things that we think there is no silver bullet. All of these things will need to be deployed to decarbonise the sector, but CCS seems to be the one that can facilitate the refining system being part of chemical circularity and the refining system delivering low carbon hydrogen. So we think that's one of the most significant things, because we believe the refining industry will remain core to its roots. The refining industry is a conversion industry. It's grown up converting crude. It actually will need to learn to adapt to convert other things into what the consumer wants, be that waste gases into hydrogen, be that recycling of chemicals into feedstocks for conversion back to chemicals. Again, we believe the industry can deliver that and deliver that in a low carbon way, which will be facilitated by CCS.
It seems like this will be the core of the discussions in Madrid in November.
Oh, I think so. It's good. Madrid in November is going to be fascinating, because we hope the industry's got through the current difficulties it's facing, and then it needs to think about what next, when, how do we deal with this, how do we adapt, and there's lots of uncertainty.
Uncertainty is kind of exciting, so let's see how that goes. But Alan, thank you very much. I would want to ask you before we wrap up, is there anything else that you'd like to bring up or add?
No, other than looking forward to November in Madrid.
Excellent. Well, thank you very much, and you enjoy the rest of your day.
Thanks, Sandal.